Hi everyone, this is Devins Financial Weekly Stock Analysis Newsletter. Today is September 9th, 2015. Our newsletter is for your informational purpose only. We're not responsible for your gains and losses. Let's take a look at current market trend and our strategy. U.S. market is still in the correction phase, and basically stock market of U.S. is in a bearish phase. And I have closed all the long position, all the stock related index and stocks, all the long position I closed. I reduced the total position size to 10%, and half of that is in a short position. Let's take a look at the major indices and their charts. German DAX index, clearly this is going downtrend, and 50-day moving average is crossing below 200-day moving average. This is from technical analysis point of view, this is called a death cross. A long-term or mid-term trend has turned to the downtrend, so we have to be careful. German DAX index, German stock index tend to lead the world stock. Again, this is a Nasdaq monthly chart, and you see from the months, the long-term chart, the monthly chart for the past 3 decades, and you can see the Nasdaq now is crossing the 12-month moving average. That's a long-term trend reversal. In the past, when they cross this 12 months moving average, there are times they just bounce right back, but there are times also it turned to a major downtrend. We don't know what this market is going to do. We just prepare for the worst and let the market sort out itself. Nasdaq weekly chart, again, this is crossing below the 40-week moving average, and this is bearish. Daily chart, Nasdaq daily chart, and as you see, 200-day moving average become the resistance. It actually hasn't hit the 200-day moving average, it came down. So that's when I took all my long position off. When I saw last Monday the market seems like it's gonna come down, and before it even reached the 200-day moving average. So the market right now is the bearish phase. Mid cap bearish phase as well. The 50-day moving average crossed below 200-day moving average. Not a good sign. Small cap the same. Large cap, SP 500 large cap came down. This is even worse than Nasdaq. All these 3 major indices, small cap, mid cap, and large cap, are worse than the Nasdaq. Nasdaq tend to be the best performer in this market. However, Nasdaq is also coming down. Gold price, gold is still in the downtrend. Weekly chart, that was this is a gold price monthly chart, and weekly chart still in the downtrend. Daily chart, gold had a bounce back, but we don't know if this bounce can turn into a uptrend, trend reversal or not. It has a hope, but right now seems like a gold is correcting again. If this time gold price cannot stay above 1,110, well, actually 1,116, if it cannot stay above that price, we have a potential to resume the downtrend. Okay, let's take a look at silver. It's in the downtrend. Gold mining index still this previously I thought it's gonna go to the uptrend, but this thing this job broke the short-term uptrend and came down. Now rebound, and right now it's sitting at the support. And can they stay above the support or not? That's a key. Can they stay above 13? The GDX is a gold mining ETF. If it can stay above 13, it has a hope to go up. If it cannot, then that's another bearish leg. GLD is a gold ETF. It's the same as a gold price. PPLT is the platinum ETF. Now it seems like it's going to go to the downtrend again. Silver ETF downtrend again. US dollar rebounded but hit resistance at 50-day moving average. Crude oil has a potential to bottom out at this price, but again it's a key to see it's important to watch what's going to do next. If crude oil can stay above $43, $42, it doesn't break this support, then we have a hope to go up. If it breaks this support, then it will seek support again at 37.75. That's a previous low. So we just have to watch. Now it's forming a triangle. Triangle pattern is a consolidation pattern. After consolidation, whether it goes up or goes down, that's important to watch. This is the energy ETF, bearish, 3 times bearish and energy ETF, ERY. This thing has a potential to go back up again. That means energy ETF has a potential to fall again, to come down. XLE is still in the downtrend. If it's next leg down for the XLE, then it will be a spike up for the ERY. SSEC, this is China stock monthly chart. China is okay, this is a weekly chart. This is a daily chart. China stopped trading for last week, Thursday and Friday. Now it resumed trading on Monday again. China stock market is still in a downtrend. It may rebound, but 3,300 level, that is a resistance, and looks like it's just in the middle of going down. YING is a 3 times inverse of a China ETF. So it's if China stock market came down 1%, YING is supposed to go up 3%. So this is a vehicle to use to short China market. And obviously YING is in the uptrend right now, but it just we have to be careful about the risk management. I will share with you later on how to mitigate the risk. IYR is a US real estate ETF. It's coming down. It's a downtrend. JGC is a copper price downtrend. MBB is a bond fund. It's going up. That bond mortgage bond price is going up. Mortgage interest rate is coming down. Semiconductor downtrend, but rebounded. Now semiconductor is at a resistance level, so next leg can go down. Social media, same downtrend. Solar ETF downtrend. Although this rebound it's big, but guess what happened? And before it hits the moving average, it seems like coming down again. Financial ETF also in the downtrend. So financial ETF financial sector tend to lead the market. So when financial ETF come down, we can see the market in the near future. It's not optimistic. It might come down again. So my tweets last week, I have closed all the long position in stocks and stock index ETFs. My current position, I'm 90% in cash, and I'm 10% invested. And among that, there were 5% of my account value I'm used to long the gold mining ETF and the crude oil ETF, naming NUGT, which is 2 times of the gold mining ETF, and UCO is 2 times the crude oil ETF. Another 5% of my position size is used to short stock. I'm long ERY and SPXS. ERY is 3 times a bearish energy sector ETF. SPXS is 3 times SP500 bearish ETF. DHI is a home building stock. It's on my watch list. And there are not a lot of stocks in this market on the uptrend. Most stocks has turned into the downtrend. So DHI is one of the few uptrend stocks. That's why I'm watching it. Let's take a look at the chart of those things I talk about. My current position, I'm long NUGT. The reason is because NUGT has came down, hit the previous low. It tend to be a support, and I'm hoping it can spike up, hit the support and go back up. But I have a very tight stop order. See, I bought it around 2.7 when they came down and rebounded, and around that price I bought it. And 2.6, $2.60, that's my stop order. So this one I had a very tight stop. If it came down, I will get out. UCO is a crude oil ETF and 2 times crude oil ETF. And this is a daily chart. Again, this is an hourly chart. Sorry, I forgot to mention this NUGT. First, we look at is a daily chart, and then we look at an hourly chart for the to zoom in and see the movement. Hourly chart, it looks like a support is a 2.6. UCO daily chart, it looks like it's a rebound and consolidating right now. And hourly chart of UCO, this one, the stop order I putting is using this moving average, 36 moving average, 24.5. That's my 24.5. That's sorry, 21.8. I'm sorry, 21.8. Actually, I was putting the stop order as a 21.4. That's a little bit below the previous low. That's my stop order. If this ETF fall below 21.4, I will be stopped out. So that's that. And then two short position, ERY, and my stop order is around 27.2. That's previous low, around a little bit below that price. And then SPXS is a short of a SP 500, 3 times bearish fund. And my stop order is around 19.3. 19.3 is this blue line, is a 200-day moving average. So if this ETF drop below 19.3, I will stop out. And next thing I like to share with you is I got the slides reversed. I like to share with you about the position size based on the risk. I'm sorry. I'd like to share with you the position size based on the risk tolerance. And when you enter a trade, I usually calculate each trade position size based on the risk tolerance. The formula is number of shares equal to account value and times percentage of the risk I can tolerate for this trade, and divided by the difference between my purchase price and stop order price. So shares is a number of shares, account is your account value, and then when I calculate it's my account value. And risk, percentage of risk is a risk tolerance. I suggest each trade do not risk more than 2% of your account value. I usually just risk 1%, sometimes 0.5%. And buy is my purchase price, stop is a stop price based on the technical analysis from the chart. For example, when I trade SPXS, which is a 3 times of SP 500 bearish ETF, if my account size is $100,000, I'm only willing to risk 0.5% of my account value, which give me $500. Which is 100K times 0.5%. That's $500 risk for this trade. If I enter the trade at $21 per share, my stop order is at $19.3 per share. When the ETF drop to 19.3, I will get stop out. Then I use this formula to calculate my number of shares. So I can only buy 294 shares for the SPXS. So when I calculate this way, I can manage my risk for each trade and pay attention to this, and correlated trades are counted as one trade. So when I enter ERY and SPXS, those are correlated trade. They tend to go up or down together most of the times, so that I will count both trades and the same trade, both ETF. I don't want to risk 0.5% on SPXS, another 0.5% on the ERY. Then at the end, I'll be risking 1% instead of 0.5%. So the reason is if you don't count correlated trades and the same trade, you're gonna multiply your risk. So that's not what you want. So you want to count them in one trade. And okay, last, what to do in current market. Current market is in a downtrend. Okay, well, I can see the downtrend is very likely. There's nothing for sure in the market. Tuesday, something surprising may happen, who knows. But looking from the chart today, the downtrend is very likely. Therefore, the risk is very high if you were to long the market. On the other side, when the market is oversold, rebound can be very violent. You can have a lot, very high percentage rebound. Therefore, if you short the market after it has already dropped, that can be very costly. And in the downtrend, in the bear phase, market tends to move much faster than in the bull phase. For non-professional traders like you and I, investors and who has a day job, we cannot really spend a lot of time watch the market. And when market move very fast, it can cut us both way. So my experience tell me in the bear phase, in the downtrend market, I should reduce my position size and put most of the money in cash and wait out the storm. So that's a lesson learned in the past. So I should just reduce the position size. That's what I'm sharing with you. So that's all for this week, and see you next week.